What's good on this beautiful Friday? It's your boy PB, checking in from the crypto trenches. Let's dive straight into the numbers. Our boy BTC is lounging around 84.5K, still doing its favorite thing, ranging. The total crypto market cap is sitting at a cool 2.67 trillion, which is basically unchanged since yesterday. The 24-hour trading volume dropped off a cliff, down 21% to just 58.7 billion. Seems like everyone ran out of dry powder. Bitcoin's dominance is still flexing hard at 63%, while the fear and greed index is almost the same at fearful 32. For alt's performance, the best ones are Ergo, Threshold Network, GMT, and Adventure Gold. The worst ones are Fartcoin, Mantra, Wallet Connect, and Wayfinder. Let's pivot to some macro news, because the real world is still doing its drama thing. Remember Trump was out here jacking up tariffs on China again? Like up to 245% on some goods? Classic tit-for-tat stuff we saw last time. Well, China's came out and basically said they will ignore any tariff hike from Trump. But ignoring doesn't mean doing nothing. Instead of just tariffing goods, Beijing's pulling out the other weapons in the arsenal. They're hitting the American services sector. Things like travel, legal advice, consulting, and finance. They've been busy with other non-tariff measures too. We're talking widening export controls on rare earth minerals. The critical stuff needed for semiconductors, missile systems, solar cells, all the tech goodies the U.S. wants. They put U.S. companies on an unreliable entity list, basically making it hard or impossible for them to do business in China. The negotiation talk? Still stuck. China says they're open but on equal footing, and the U.S. needs to stop its threats. Okay, let's leave the depressing macro world and talk crypto news. Market makers, who are supposed to be helping crypto projects get liquidity and exchange listings, are sometimes doing the opposite. These market makers get loan tokens from the project, often with the promise of repaying them later at a higher price if they don't get the listings. But instead of providing healthy liquidity, they just dump the loan tokens onto the market. Once the price is in the gutter, they buy the tokens back super cheap, repay the project with the now worthless tokens. Big names like DWF Labs and Wintermute are firms that have done variations of this in the past, though DWF denies selling loan assets, and Wintermute CEO is just like, yeah, we're in the business of making money by trading, not charity. Fair enough. Why do projects agree to this? Market makers promise to use loan tokens to create liquidity and get them listed on big exchanges. In theory, great, but reality is often a lot worse for many new projects. Next story. After what sounds like a brutal layoff fiesta, the Kraken IPO date is finally looking ready for a public offering. Founder Jesse Powell planted the seed back in 2021, and now Bloomberg's reporting their parent company, Payward, is aiming for early 2026. But before Wall Street gets a look, Kraken's been going through the shredder. New co-CEOs came in late last year and immediately went full barbarian mode, doing a 15% workforce reduction. That's 400 plus jobs gone by year end. Why the bloodbath? It's the same old story when the market gets quiet. Global trading volumes nosedived 27% in Q1 2025, wiping almost $1 trillion off the market cap. Exchanges live and die by transaction fees. So when volume disappears, the math gets ugly fast, and the first thing they cut is people. Getting ready for an IPO by gutting your team during a market crunch? It's a massive gamble, and all eyes are definitely locked on this experiment. Last crypto story. Those infamous North Korean hackers, the Lazarus Group, are apparently leveling up their game and getting seriously sneaky. Kenny Lee from Manta Network tweeted about getting hit with one of these. He got pulled into a Zoom call arranged by a known contact, saw legit faces on video, but there was no sound. Then came the classic download the script file to fix audio prompt, which is obviously code for install malware and get wrecked. This isn't just a one-off trick either. It's part of a bigger, evolving campaign by North Korea's cyber army. Lazarus is just one piece of their sprawling operation, deploying subgroups with tactics ranging from fake job offers to malware packages and extortion. Security experts are warning that this audio issue Zoom call is a known move in their playbook. Familiar faces, no sound. Prompt to download a malicious patch. Once you install the patch, you're wrecked. Time to switch up to the DeFi news of the day. Remember a few days ago when KiloEx was hacked for 7.5 million? Standard DeFi exploit playbook, but targeting the weakest link, the pricing oracles. The hacker figured out how to feed the oracles manipulated data, tricking the DEX into thinking tokens were worth way less than they were. This let the attacker basically buy tokens at a highly reduced price before anyone noticed. Now, here's where the story gets weird. After getting hit, KiloEx went on X, did the usual we're investigating thing, and then offered a 10% bounty, $750,000, if the hacker returned 90% of the loot. They also said they were watching the addresses and would try to freeze the funds and work with authorities. But get this, a few days later, KiloEx announced on X that the hacker actually returned the stolen tokens. Seems like a nice payday for the hacker for simply exploiting a protocol. Next DeFi story. Let's talk about Hyperliquid, because these guys are absolutely dominating the Perps DEX game right now. They built a commanding position, hitting nearly 70% market share in recent weeks. They processed a whopping $175 billion in March alone, and we're already at $83 billion halfway through April. This growth trajectory is huge and shows a real shift towards people preferring decentralized perps. If you look at the chart, it's basically a straight line up for Hyperliquid. Why are traders flocking to on-chain perps like Hyperliquid? A few reasons. You get leverage, which lets traders and degens amplify positions without locking up a ton of capital, perfect for sophisticated or degenerate trading strategies. Crucially, it's non-custodial, meaning your funds aren't sitting on a centralized exchange that could face insolvency issues or withdrawal freezes during crazy times. Your keys, your crypto, even when trading perps. Plus, smart contracts handle the execution and liquidations automatically, eliminating potential settlement chaos that can happen on SEX during extreme volatility. Last DeFi story for today. Let's look at something a little heavier. Coming out of Yemen, turns out necessity is driving crypto adoption in some pretty intense ways over there, mainly because of the civil war and U.S. sanctions hitting their financial system, especially targeting the Houthi group. You might think crypto adoption would be low in a place dealing with infrastructure issues and conflict. But DeFi platforms account for a massive chunk of Yemen's crypto web traffic, over 63%. Compare that to global centralized exchanges, which are only around 18%. That's huge. Why the big lean into DeFi? Because their traditional banking system is often inaccessible or unreliable due to the war and sanctions, like that hit on the International Bank of Yemen recently. Pretty wild to see DeFi usage dominated by necessity and geopolitical conflict rather than just degens aping into yield farms. Shows the tech's power when traditional systems fail, even if it's used by groups the US doesn't like. Okay, for our airdrop, today we're diving into Ostium. It's a decentralized perps trading platform built on Arbitrum. But here's the cool part. They're trading way more than just crypto. We're talking Forex metals, energy indices, even real-world assets. Now, for the alpha you're here for, Ostium has launched a points program. Everyone knows what that means. Strong signal for a potential future token airdrop. The grind started on March 31st. They're distributing a minimum of 500,000 points weekly based on user activity. How do you rack them up? The main ways are trading on the platform, getting referrals, and providing liquidity. There's also a small chance for points if you make substantial open source contributions, if you're into that builder stuff. All right, that's all the alpha I got. Stay safe out there in these markets. PB out.